Welcome to the M&A Unplugged podcast. Our mission is to help you be better prepared for your business acquisition or sale. Being prepared will ensure you maximize returns and minimize risks. This is M&A Unplugged with your host, Domenic Rinaldi.
Welcome back. I'm Domenic Rinaldi, host of the M&A Unplugged podcast. The human capital of a company is by far its most important asset. The people and the systems and programs that support those people can make all the difference in a company's success or failure, which is why this aspect of due diligence during an acquisition is so critical to ensuring whether or not this is the right company to acquire. My guest today, Dr. Solange Charas, is an expert in human capital metrics. In addition to her adjunct teaching positions at universities such as Columbia, NYU, and USC, Dr. Charas has built a successful consulting practice, and one of her proprietary tools is the HCMoneyball platform. This platform helps executives and M&A professionals understand, monitor, calculate, and project ROI in human capital. And she can do this without ever speaking with employees, so confidentiality is maintained, and it also limits the distractions to the employee base. Her platform utilizes all the aggregate HR content in the data room or financial systems, so acquirers and executive teams can obtain an objective view of the human capital. I found Dr. Charas' information incredibly compelling and a must listen to anyone struggling with how to evaluate the people in an acquisition or how to properly manage the existing human capital in your own company to have the most successful and significant impact on the top and bottom line. Before we get into today's episode, if you want to avoid common deal pitfalls, the risk of losing substantial dollars, you need to know how ready you are for a transaction. Because I believe proper preparation is so critical to your deal success, I have developed a 5-minute assessment that will allow you to immediately gauge how ready you really are to buy or sell a business. You can access these free assessments and other free resources on our website at www.k2advisor.com/resources. Being prepared is critical to ensuring that you maximize returns and minimize risks. Thank you for being here and hope you enjoyed today's episode. Dr. Charas, so nice to have you here this morning.
Thank you. I'm delighted to be with you today.
Yeah, we have got a great topic today. I'm so excited to talk to you about this. But before we get into it, if you could give everybody just a quick bio on yourself, and then I think they're going to be fascinated with this topic.
Sure. So I am in the human capital function. I'm an expert in human capital metrics, but probably I got there in the strangest way that you would imagine. I actually got there through finance. So my MBA is in accounting and finance with a minor in taxation, which is not your typical background for an HR person.
Not at all.
And my entire career, I've always approached the HR function through this financial lens. And I speak a completely different language than most HR people speak. In fact, my clients used to say, I've never met an HR person like you before. So I've always been sort of at the cutting edge and done HR as if I were managing a financial function in the organization. I've been the Chief Human Resources Officer for 3 organizations, 2 financial services and 1 professional service. I was a consultant for Ernst & Young and Arthur Andersen in their tax group. And what I do today, post-PhD, is I spend about half of my time educating. So I'm an adjunct professor at Columbia, NYU, and University of Southern California, USC. And I teach essentially 3 subjects. I teach finance for human capital management. I teach data analytics and quantitative model building. And I teach also human capital analytics, so it's sort of the same area. And I teach total rewards because that's typically the largest line item expense for an organization is what they pay people. And I'm basically teaching the next generation of HR professionals to look at human capital through a financial lens, through a operations lens versus a subjective sort of HR management lens. Not that there's anything wrong with that, but we need to think about human capital in a different way because it is so impactful to an organization. So much so that the SEC has now said that it's material.
Wow.
So we need to teach the next generation to understand the materiality of human capital management.
My view on that is your human capital is your number one asset. More important than anything else. Without good human capital, you can't maintain clients, you can't grow your business. So I always contend that's your number one asset. So you spend half of your time teaching and the other half?
The other half I spend dedicated to my company called HCMoneyball, which is a technology company that provides an application for organizations to instantly calculate their human capital metrics and be able to correlate the performance in human capital to corporate financial performance. So we have the only platform that actually combines human capital information with financial information. So in one visual, you can say, oh, look, my HCROI is going up, and that's corresponding to my EBITDA going up. So we must be doing something right. Or identify where problems are in the organization by tracking human capital performance.
Yeah, I have to admit, we had gotten introduced, and when you told me what you did, you are the first person I've ever come across that's put it into this context, the human capital, and tried to, like you said, subjective part of it is very important, but really try to look at the financial metrics. So key. And you also have an extensive background in M&A as well.
Yes. So I have been doing M&A since the mid-90s. I know I don't look that old, right?
Not at all.
It's the work that keeps me young. I've completed over 65 due diligence exercises or events from different perspectives. From the board, because I am a public company, or I was a public company board director of a highly acquisitive organization. So I've seen transactions from the board level. I've done it from the buyer side, where we acquired, when I was in one of my companies, we acquired about 25 companies in a year.
Wow.
So as a buyer, I was doing all the HR due diligence. And from the seller side, so as a corporate executive, I prepared 2 organizations for sale. So I know what it's like to be a seller preparing a company. And as a transaction advisory services consultant. So as a third party, providing input and guidance on understanding the economic value of a target organization. So I've
fascinating background, unbelievable experience. But why don't we start off with what are human capital metrics?
So human capital metrics is essentially a way to understand the trends and the accretive impact of the collective human capital in the organization. So we're actually looking at human capital in the aggregate, and we're trying to understand the trends and relationships of those performance indicators to financial performance indicators. So as I said before, we look for, at a very high level, there are about 5 human capital metrics that we know are very closely related to a company's financial performance. And when I talk about financial performance, I'm typically talking about EBITDA, which is bottom line. This has been studied for about 40 years in the research community, in the academic community. The enlightened human capital and financial practitioners in the commercial world understand that there is a link between human capital and corporate financial performance. But the driver is typically a financial person who is not really interested in digging down into Bobby Sue's and Sally Mae. I shouldn't say Sally Mae, that's too financial.
Right.
Sally Jones's experience in the Dallas office. And that's not what we look at. We don't look at individuals. We look at trends in human capital in the organization. What are those trends? The biggest one is human capital return on investment. It is an algorithm. It's easy to calculate. You don't need to talk to anybody. And we know that there is a very strong relationship between human capital ROI, or HCROI, and EBITDA performance. So we examine that, and that's an easy thing to calculate. And we look at it month by month to see what the trends are. And we can curate data from the data room. So we don't have to talk to anybody in the company. We're just purely doing financial analysis on human capital performance using secondary data. And HCROI, productivity, investment in training and development has been shown to have a strong correlation to employee productivity, and employee productivity has a strong correlation to profitability.
No surprise there.
We look at things like attrition, right? When you have a lot of attrition in the organization, it is extremely costly.
Now, is this part of the 5 metrics, attrition?
No, it's actually the second level down, but
okay.
the five metrics are HCROI, human capital value add, which is essentially the rate each employee contributes to profitability. We look at productivity, the employee productivity in the organization. We look at expense ratio, so the percent of total expense that goes to employees and employee programs. And we look at income ratio. So we want to actually see a correlation between income ratio and expense ratio. We want to see that HCROI and HCVA are going up over time. And we're adding another indicator now called HEVA, Human Economic Value Add. And it's just another algorithm. It's just another lens through which you can look at the organization and have a top line assessment as to whether or not your investment in human capital is generating a return for the organization.
And that's things like education programs, management succession programs, things like that?
It's training, it's recruitment, success, it's retention. Who are you retaining? It's management stability. It's the amount of training and development. We look at mobility, whether or not you move people through the organization, because we know that organizations that have high mobility tend to have longer tenure. Employees want to move within the organization, so they'll stay with you. We look at all sorts of things related to equity. We look at pay equity. We look at diversity in the organization. So, and again, we don't have to talk to anybody. This data already exists in the data room.
So I've got a question about that. Does it exist in the data room, or really aren't you probably needing information that the normal financial transaction professionals are not asking for? Sounds, I've seen a lot of data rooms, and I'm not certain they get down to some of these levels when it comes to human capital.
So usually in the human capital folder in the data room, we're going to have I-9s. We're going to have payroll records, monthly, or however often the payroll is processed. It's sometimes monthly, sometimes it's biweekly, sometimes it's semi-monthly, right? But we're going to have that. Usually they put in org charts, so we can see org charts by month or by quarter. So from an HR data perspective, if we've got listings of demographics by month, right? So it's just a data dump from your HRIS system, which is usually requested, or payroll by payroll period, we've got that data. And then the other data we curate from the pre-closing trial balances for anything that's coded to HR. So that could be recruitment, that could be onboarding, that could be outside training, that could be contractor costs. So anything that's coded to HR is right there in the pre-closing trial balances. We curate that data, we match it up to the payroll data and the employee demographic data dump, and we have everything that we need.
Fascinating. That is just fascinating. In a period that we're in right now with COVID, how does that impact your modeling? I mean, everything's been turned upside down, and some companies are benefiting, right, from this, and some are, on the opposite end of the spectrum. Yeah. How does your model accommodate for what's going on right now?
Well, the model accommodates based on the trend data. So we know that COVID had an impact, right? A positive impact on some companies, a negative impact on others, and a neutral impact on, a segment of the market. We're actually doing a lot of research in this area to really understand how organizations can understand how they've been impacted and what they needed to do to prepare for the future of HR post-COVID. Yeah. And what we found is that there are a couple of industries that have really been decimated. Yeah. The food service industry with indoor, with casual dining and elegant dining, the hospitality industry with hotels, mm-hmm. Cruise lines, airlines, they've been badly impacted. But other industries are actually thriving. Yep. Pharmaceuticals, mm-hmm. The box shops like Costco and Amazon, I mean, they are literally exploding.
Home improvement is
exploding. Yep. So, we have to understand the exogenous variables, the outside variables, to really contextualize how an organization is going to perform in the future. And we do that in my approach to due diligence. As I said, we do a lot of internal analytics to understand trends over time, but we also do external analysis. We look at external competitiveness. So we'll pick 3 or 4 companies that are the most similar to the target that we're doing the due diligence on, that are publicly traded. And we look at their data over time. So we know that COVID is an anomaly. And as we emerge from COVID, some organizations are just going to do great and others are going to have to rethink their business model. In fact, the way we're looking at it is in a 4-box. So we have some organizations that are going to surge. We have some organizations that need to do some minor modifications to get back on track. We have some organizations that are going to have to do major modifications, and some organizations that are going to have to rethink their entire business process, their business model. Yeah. And we know what those organizations are based on some financial indicators like EBITDA to market cap, and EBITDA to net debt. Right? So we can use financial indicators to place your company in the right box and then use that to inform what the strategy going forward should be to create a healthy human capital in your organization that is going to be sustainable and support your financial projections going forward.
So I would imagine many companies right now are trying to figure out what is the right level of what box are they in, and what's the right level of resource, human capital resource that they should have, right? I mean, look, you're hearing announcements every day. These big companies are going to furlough, but are they doing that in a vacuum? Or, I'm assuming some of your modeling could help them think through what is the right amount of resource based on the trends?
Absolutely, absolutely. One of the things, as I said earlier, there's a strong correlation between HCROI, human capital return on investment, and EBITDA. And we can model the break-even point. So we can say, and human capital return on investment is usually a ratio. It's measured as $1 in, what's HCROI? So for every $1 you invest in people and people programs in the organization, what return are we getting on that investment? And it's, for some organizations, it's in the single digits. I mean, we always want it to be more than 1, right? Because we don't want for every $1 we invest in people to get a return that's below our $1. Right. So we're always looking to make sure that the HCROI at a minimum is 1. For some organizations, depending on what industry you're in, it could range anywhere between $1.80, $4. I've looked at interestingly enough, at the mining industry, the energy extraction industry, And for a group of publicly traded companies, their HCROI is in the 70s and 80s. So for every dollar I invest in somebody, I get an $80 return back.
Wow.
So, you know, it ranges and it's based on your industry. And that $70 or $80 might sound great, but if your competitors are getting a $120 return, you know, it sounds great, but contextually you're behind your competitors. So you have to look at what your competitors are doing.
Broader market. And I would imagine during the period now too, with M&A activity going on, if you're looking at a target company that has suffered or one that's doing well and maybe is looking for a premium valuation, understanding these HR metrics are going to be critical for an acquirer to really understand, is that company right sourced? What's going to happen if we come on the other side of COVID, and if they've done really well and they come back down to a level set, what does that mean for the whole operation?
Exactly. And it also matters on what you're going to do with that company when you acquire it. Are you going to let it be a standalone and have a place in a portfolio? Are you buying that company to bolt on to another, right? To integrate into another. And it's really important that you understand the metrics of both organizations if you're going to integrate them. Because you could actually be harming your existing portfolio company by bolting on an organization that has lower human capital performance than the original company, and then expect that company to do even more.
Right.
You're hurting yourself. You really need to understand whether or not these companies are aligned. And human capital ROI is a reflection of an organization's philosophy around human capital. As you started this show, you said people are our greatest assets. Well, the proof is in the pudding, right? And if you've got one organization that really does value and invest in human capital and one that doesn't, you've got an indication that you've got a culture clash.
Yeah. And, you know, and I think the statistic is that 70% of all mergers and acquisitions fail to achieve the return on investment targets, right? So
is this the time when I get to say, as Albert Einstein said, doing the same thing over and over again and expecting a different result is the definition of insanity. And these 70% of the transactions that fail to meet their goals. And, you know, just to be clear, it's not that they're failed transactions. They could be perfectly good transactions, but they failed to meet the goals established at the time of the transaction.
Right.
You know, we're doing HR due diligence and financial due diligence the same way over and over and over again and expecting a different result. And what I'm suggesting is that we use a different approach, a modern approach to HR due diligence that doesn't look at the traditional things like compliance, like unfunded liabilities, like just a check the box on compensation, a check the box on benefits, a check the box on headcount. It's really a balance sheet approach that is not telling us the whole story. You don't look at a balance sheet of a company and expect to understand whether or not they're a high or a low performing organization. You look at their income statement, right? You look at the uses and the sources and uses of cash. You look at cash flow statement. You look at those things to get a story. So looking at human capital from a balance sheet perspective is not giving you the story. You have to look at human capital through an income statement approach. Look at things over trends, understand how those trends are correlated to financial performance. And if I could just go back to one thing, because I feel like, you know, I have OCD, which, you know, you can expect you'd want from somebody that's doing due diligence.
Absolutely.
In fact, in my family, we have a little touch of OCD to the point where we don't even call it OCD. We call it CDO because we want the letters in order. So my OCD kicked up because I didn't really get to finish answering one of your questions, which is how do we know whether or not we've got the right staffing levels, the right types of employees in the right jobs when we're doing a transaction. And I started to say that we can correlate HCROI, which is typically, you know, like 1.8 or 4.9 or whatever that trend of HCROI is to EBITDA, to find that break-even point.
Mm-hmm.
We can actually say if your HCROI falls below 1.2, that's when you start seeing a decline in EBITDA. And we use that threshold level to prioritize and to analyze where we're going to invest money, dollars in human capital. Does it make sense to put it all in cash payments? Does it make sense to invest in training and development? So we can actually help organizations prioritize where they're going to invest in human capital to improve that return number, and not just guess, because that's what HR people do. As much as I love them, they run HR as if it were a belief system, superstition. Oh, I think we should do this, or I think we should do that. And what I'm suggesting is you don't need to base your decisions on superstition. You base it on data analytics, and you let the numbers tell you.
Let me ask, how does this coexist with management teams thinking around how to invest in marketing or R&D, right? So they're looking at all of those other things and deciding how much money are we going to put in. So how does this sit side by side with all of those other big questions that an executive team is asking themselves?
What a perfect question to ask. With human capital analytics, we have a way of comparing apples to apples, right? If you, and I used to do this, I'll give you an example. I used to do this when I was a chief human resources officer. I used to have people come to me to try to sell me things, right? Buy this technology-based performance management system, or buy this technology-based applicant tracking system. And my question to them is, how much is it going to cost, and what should my return on investment be? And they would say, oh, this is going to cost you $250,000, and I'm not quite sure what your return on investment would be. And I would say to them, come back to me when you can tell me what my IRR and my NPV and my ROI is going to be, because how am I going to convince my CFO to pony up $250,000 to me when I can't prove a return on that investment, when the R&D guy is going to him or the operations guy is going to him and saying, give me $250,000 and I can guarantee this kind of a rate of return and this level of IRR. You're not giving me any ammunition to actually create a compelling argument. So human capital analytics is a way for you to actually value and cost and project the return on investment in human capital programs, human capital investment, so that you can stand toe-to-toe with the other functions in the organization that speak a financial language while you're out there speaking HR. So and that's what I'm doing.
I would imagine it's got to be tough for HR executives to get a seat at that table. Well, they may have a seat at the table, but
they just can't talk while they're there.
You know, to get a mind share when people often just equate cost with that function.
And we now know that it's not simply an expense to the organization. It is an investment in an intangible asset, and it is material. And that's what the SEC said.
Do you have some specifics or some examples that you could point to, especially if they're in an M&A sort of construct around how people would view this?
Yeah, let me just share my screen. I'll show you a good example.
All right.
Of something that I did. This is really a client example that was scrubbed. And I'll tell you the genesis of this. The genesis is I was engaged to do an HR due diligence back then I actually did this work in 2012. So in 2012, we weren't calling it human capital yet. We were still calling it HR. For a transaction for a technology-based organization. And they were an $85 million company. Projected, as you can see on the left side, the 3-year projection was to grow to a $123 million revenue company with a cumulative $310 million. And the projected EBITDA was cumulative EBITDA was about $64 million. So that's what the financial due diligence and the pro formas had expected this company to produce.
And this was going to be on a standalone basis, or this was after the company would be integrated into the existing operation?
No. Standalone. This was
standalone.
A standalone.
So this was going to be a standalone acquisition.
Right.
Got it. Okay.
And they brought me in and I did my traditional HR due diligence, because this was back, 2012, 2013, looking at all the things that the traditional check the boxes. But then I also did my modern approach, where I looked at the performance of the organization over time, looking at competitors and looking at how the human capital aligns to the business strategy and the business model. And what I identified is that they actually, the first clue was some of their metrics were a little wonky. And so I wanted to dig into that. So what metrics do is they basically tell you where you need to look, because HR is a big topic. And you can, it's like trying to find a needle in a haystack. So it's sort of like putting the organization through an MRI machine to figure out where the problem is. And then you focus your attention there to sort of unpack where the problem issues are. And one of the things that we identified was there was a mismatch in the organization structure to the business model. And there was a suboptimal approach to the staffing function. So in other words, they had too many of one type of employee that was not driving revenue or profitability, and not enough of another kind of employee. And they're all engineers. And basically, we did some realignment so that we looked at employee productivity and we looked at the impact on EBITDA, and we made some recommendations on how they're staffing, how they were organized, and where they should be investing their human capital dollars.
And did management have any inkling that maybe this was a problem before you did the analysis? No, none at all.
No, because management designed that organization. They thought they were doing the right thing. But again, they were basing their human capital decisions on assumptions, on guesses, on beliefs. And what we did is we just showed them the data and they got it right away. The left-hand side is the pro formas pre-acquisition. We actually changed the deal value because we said, you will not be able to achieve your 310 million cumulative revenues with this organization structure. And we actually modeled it out, and it resulted in a reduction in that. So in that instance, I was obviously working for the buyer. It resulted in a reduction in the deal price. 3 years later, out of curiosity, I went back to the organization and I said, you know what, will you share your actual performance with me? Just give me the 3 years, years 1, 2, and 3, in just your financial statements. I don't really need to see anything else. And this is the actual performance achieved over that 3-year period of time, because they implemented my post-acquisition recommendations.
Wow.
And we know that because I said to them, you probably only need between 550 and 575 employees if you're staffing your organization correctly. And if you are staffing your organization at lower levels, like less employees, you don't need to add additional office space to house those extra 100 people or so. And if you looked at their pro formas in the 3-year projection, you can see that SG&A and real estate are the 2 biggest line item expenses for the organization. So by being able to manage those 2 expense categories, we actually generated a much better outcome for them. And you can see the proof is in the pudding. Another $37.5 million in cumulative EBITDA over the projected. Their profit margin went from 20% or 30% cumulative, it went to 30% cumulative versus the 20% cumulative, which is an improvement of about 147%. And all in all, this was a great story. And it was a great story because they understood the inherent value of managing human capital the right way. And again, we didn't go in and change any of the programs. We just made strategic recommendations to them.
And how do you know that the increase in revenue was a result of the HR strategies that you laid out for them and not some other program that was already in the works?
Well, of course, it's hard to tease out exactly what the cause effect was.
Yeah.
But we measured, we projected employee productivity. And with technology companies, it's all about productivity.
Sure.
We projected out productivity, and then you can see in the the 3-year actual company performance, they had much higher levels of employee productivity. And productivity is revenue divided by full-time employee equivalents, FTEs.
That's amazing.
So we might not have been the only reason their cumulative performance increased by about $25 million, but they couldn't have done that if their employees weren't as productive as they needed to be. So
absolutely,
we'll take a little credit for that. We'll take
absolutely.
A lot of credit for EBITDA.
Yeah. And you had a model client that actually implemented your strategies, right? So they hired you, paid you, and they actually followed your model, which is sometimes a real challenge, right?
Yeah. And a lot of times organizations will say, oh, we don't want to spend the money on that because we don't think there's any return there. Net, they spent between the due diligence work and the consulting work post-acquisition to help them with those HR strategies and the reorganization work, they spent about $90,000 on consulting fees with me. They spent $90,000 on consulting fees and got a $37.2 million bump. I'd say that's a pretty nice
good return on your investment.
Exactly. And also anything that they spend with me pre-due diligence gets rolled into the acquisition price and gets amortized. So they didn't even have that $80,000 hit in year 1. They amortized it over 3 years. So even better story, right?
So Dr. Charas, what kind of information were you able to share with them ahead of time to support your findings? Like what, because they had to get comfort, right? That you were, you had some good numbers and you could show them, why this one, you got a reduction in the purchase price for them. So not only did they buy into it, but obviously the target company came to the realization that you were right. So what kind of information were you able to share to get everybody comfortable?
So that was like the bitter pill that the company needs to sort of understand, is that their human capital isn't as healthy as they thought it was. You show them the numbers. I mean, numbers, I'm going to quote now from Mark Twain. Mark Twain says there are 3 types of lies, damn lies, and statistics.
Yes,
right? So you show them the numbers. And just like your financial due diligence is using, in some instances with very sophisticated organizations, AI to understand the financial performance of the company in each one of those expense and income categories. We're using the same rigor. Now, I don't want to say I use AI, but I am using a form of AI. It's not machine learning, but I am using feedback loops. I am using external data for benchmarking, and I'm showing data. I'm showing you evidence. And it's sort of hard to not buy into the concept of data analytics when the proof is in the pudding, and I chart out the relationships and they can see with their own eyes the correlation between HR analytics and corporate financial performance. And they go, oh yeah, okay. Something that I had always thought intuitively is a relationship. You are now proving out with numbers. And I can forecast those numbers too. So I can look at trend data, just as the financial due diligence experts, they're looking at past performance and projecting out future performance. I can do the same thing with the HC information to really understand the value that you're buying and the accretive impact of human capital over time. We're looking for sustainability. Right? That's what everyone's looking for.
Of course,
but nobody looks at sustainability from their human capital, from their employees. So we had one case where the financial due diligence guys went in. They basically gave the company a clean bill of health. In the last minute, they thought, oh, we've got about 500 employees. Maybe we should bring Solange in to take a look at this. And what I discovered, which the financial due diligence people didn't, and no offense to them, they don't know what to look for, is that this organization had 77% attrition in their key value driver position in the organization.
Oh my
and
goodness.
no pun intended, they were drivers. This was a delivery company, and their drivers were the key source of their revenue, and they had 77% attrition.
And nobody picked that up in the other diligence. Now, how could they miss something like that?
Because they look at it like a balance sheet. They looked at head count January 1, they looked at head count December 31. The numbers were sort of close. It only showed that there was about 10% attrition in the starting balance and the ending balance.
Right.
And what they didn't look at was the balance every month of head count, because that's an income statement.
Wow.
An income statement approach, not a balance sheet approach. And everyone does human capital as a balance sheet. How many heads do we have? What are they costing us?
And there must have been a tremendous loss of productivity. When you have that sort of attrition, that's got to wreak havoc on your company.
Yeah. So, and we were able to project the impact to productivity and the impact of productivity to revenue, because we were able to understand the average level of revenue per employee.
Yeah.
And we calculated out that this company that was doing about $55 million in revenue lost out on about $14 million of revenue because they had that instability in their revenue driver. No, again,
did your client wind up walking away from that deal, or did they renegotiate it? They renegotiated the deal.
Yeah, they renegotiated the deal.
Wow.
The other thing, other than just projecting out the impact on revenue, we were actually able to isolate that cost of attrition was about $1.2 million, $1.3 million in hard dollar cost, in recruiting cost. So it's not just the loss in productivity, it's the out-of-pocket expense in actually recruiting 77% of your critical workforce. Right. And that $1.2 million could have fallen right to the bottom line if they had better management in place. And I don't want to blame the management, but for mismanaging, I'm blaming the management for not being aware.
Right.
It was in their blind spot.
Somebody's got to be looking at those metrics and understanding that something's wrong.
Right.
Yeah.
And we compared them to a benchmark set of organizations. Again, companies, until the SEC or the investor community puts a stake in the ground about what needs to be reported for public companies, and whatever public companies do, private companies usually adopt as best practices. We actually don't know what the attrition rate is in other organizations, public companies. They don't tell us, oh, we had 20% attrition. They might in the future have to report that if employees are material, but we can get indicators from other things like HCROI and HCVA and productivity, because they tell us what their total headcount is. And if they're a public company, they're probably on, in fact, we curate data from other public sources as well for private companies like LinkedIn. If you buy a premium membership to LinkedIn, you can actually see information about the human capital of an organization. It's not 100% reliable, but it is close enough, as they say, for government work.
Right.
So we understood that the 77% attrition rate was very high for the industry, was high compared to their closest set of public company competitors. And that's not acceptable.
Yeah. What great work. And I know that you believe that the subjective has to go with the objective, that they're both important pieces, right? You have to have the whole picture, but this is fascinating to me. Before we wrap up, I do want to ask you though, for privately held companies, there's a ton of M&A activity going on in the lower middle market right now, especially with companies who are somewhat healthy, looking to pick up assets that are not so healthy. And they don't have, true HR departments, they can't maybe sometimes afford expensive consultants. Is there some advice that you would offer up to these lower middle market private companies about how to approach this exercise, at least at the highest level, to get a benchmark?
Yeah, absolutely. It's not difficult to calculate some of these metrics. They are algorithms. They are actually in the public domain. The International Standards Organization, ISO, last January of 2019, released a standard called the Human Capital Governance Standard. And it's ISO 3414, 30-414. And in that standard, which they issued because they believe that organizations that have higher levels of transparency actually perform better. They outperform organizations that have no transparency. And this ISO standard is actually really interesting because it's not a standard that's designed for investors, for outside people. They want organizations to be transparent to their employees about an organization's performance against these human capital indicators. And they define HCROI, they define HCVA. I've written about it. If you just Google me, I did an article for Financier Worldwide on doing HR due diligence in an M&A environment, especially pre-COVID, post-COVID. And I define the top 5 measures. So you can do a Google search for me.
That's awesome. That's
you can also find that article if you go to HCMoneyball.com and look in our resource section. So that'll save you the need to do too many searches. And I've given you the algorithm for all 5 top metrics. Yeah. The thing about those top metrics, it's like a treasure map. You know, when you look at a target acquisition, you want to figure out where to dig, right? Either for the good stuff or for the bad stuff. And what the HC metrics indicators do is it basically maps out the human capital landscape, and it gives you an X marks the spot so that you can start digging where you need to dig and not think, oh my God, I'm in the Saharan desert and everything looks exactly the same. And it's the first line of attack to say, do I have healthy or unhealthy human capital? If I have healthy human capital, bravo, what do I need to do to sustain that? Yeah. If the indicators are not good, then you need to figure out how to unpack that to figure out if it's a big fix or a little fix. And that's where we need those human capital experts, you know, those program experts to dig down into the human capital area. I'm giving you the MRI view, then you hire your cardiologist, your renal expert, right? The guy that, you know, works on your kidneys, the guy that, you know, your internist, right? You hire the specialist to deal with the issue that's identified as being the problem.
Yeah.
So
tremendous information. This is outstanding. I think we got a winner here. People are going to love this content. We said it at the beginning, human capital, my perspective, it's the most important thing, way more important than just about anything else. And so you've given people a platform to really measure it.
Yeah.
Thank you so much for being here. This has been a pleasure.
My pleasure.
Yeah.
Thank you. Domenic.
If people wanted to get in contact with you, how could they reach you?
They can write to me at S. Charas, so my name, my first initial, my last name, at HCMoneyball.com. So you guys know about Moneyball, right? It's the analytics approach to enhancing the Oakland A's baseball, the Michael Lewis book. Yep. We're doing the same thing. We're optimizing the investment in human capital by using the rigor of data analytics to inform decision-making.
Outstanding. Outstanding. Thank you again so much.
Thank you. It's been a pleasure.
I hope you enjoyed this episode. All of today's information will be available in the show notes. If you enjoy our content, please remember to subscribe and review our podcast. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.